Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn. Chicago wheat. The break in early October, below the August to October ascending wedge pattern from last year, which is highlighted in blue on my daily chart, has been the most recent seminal moment here. 12 weeks ago, I laid out two avenues on what I thought might be the possibilities here. Of these two, the first avenue was, and is, the way the market chose, and is why prices have moved lower. To recap my thoughts, here's what I said at the time, and I quote, "The straightforward move down, with potential targets for the ascending wedge pattern. Thus, the primary target X on the downside was already achieved in the 860 area, whilst the secondary, harder to reach target X1 is way down below in the 712 area," end of quote. Since then, prices dropped below all the moving averages, and in early December last year, the market pushed below the recent August low at 743, the lowest low and low close since late September 2021. In the process, it also pushed below the March 2014 high at 724. However, that seemed to be enough at the time, as only a little below is the congestion band 725 to 721, which has the March 2014 high at 725 and the October 2013 low at 721 within it, and the move down in early December last year halted there. Below the 725-721 zone, there appears to be no clear support until the January 2021 high at 693. The market chose to stage a recovery during December, but this was limited, as prices only reached up to the overhead congestion created during July and August, between about 780 to 843. Inside this congestion is a declining short-medium moving average, currently 774, and also this slowly declining, medium moving average, currently 823. At the start of this year, the market peaked within that congestion, and we've moved lower more or less since. The most recent action has seen a new low this week, the lowest since September 2021. But the market seems currently to be having trouble pushing down through the combination of the March 2014 high at 725 and the October 2013 low, I think it is. Let me just double check that. Yeah, it's October 2013 high at 721. The bounce up this week has been enough to possibly threaten a weekly key reversal, but not just yet. All these moves has left us with two possible scenarios going forward now. Primary focus is on what has developed from a bear channel into a descending, expanding wedge pattern. Looks quite nice actually, highlighted in bright green on my daily chart and originating from October last year. And that's currently 593 to 772. The upper trend line here has had the added benefit of the short-medium moving average, currently at 774, entwined about it since late November last year. There is a further focus, and one that may take up the running from this wedge pattern, that's to look at the whole May last year to date action as a possible large double bottom, even Eve type action, but this idea has diminished since prices made a new low this week. I'll now reprise some thoughts I had last week on this matter, which are still quite relevant, and I quote, "At the moment, my thoughts are that the descending expanding wedge pattern is still leading lower, and with the short-medium moving average entwined with the upper trend line, then the resistance there ought to be quite good," end of quote. Thus, if prices do turn low, then look down to the January 2021 support at 693 and then the 50% absolute Fibonacci line at 682. Meanwhile, topside looks quite good with the intertwined resistances, but if they are breached, then look to the sideways medium moving average overhead, currently at 823, as the next possible resistance of note within this same congestion band. Chicago corn. Now, if you start to have a headache whilst looking at this daily chart, come join the club. We have jackets. There is still, after many, many weeks, a lot of things going on here, as you can easily see by the color-coded trend lines. Here are some of the key elements. The first element is the impact of the long moving average, currently at 682. I won't go into past details as the current ones are interesting enough already, with the market being capped at the start of last week and again yesterday and today by the same long moving average. Then there's the July to October 2022 ascending wedge pattern, highlighted in red trend lines on my daily chart. I personally found this to be the most elegant of all the elements. In mid-October, the market exited this pattern, and for a couple of weeks it seemed the prices were looking to see if there was enough bearish pressure out there to push prices lower. Well, there was. And it was in November last year when the market started moving lower and laid out a primary target in the 648 zone and a secondary much harder to reach target X1 in the 550 zone. In early December, prices dropped down enough to reach the primary target and in the process punched down through what appeared to be a strong zone of support consisting of the 50% Fibonacci line of the September 2021 to April 22 move at 661 and the medium moving average at the time, currently 674. The move down stopped short of testing the next supports, Fibonacci-based supports, in the 622 zone at the start of December last year before another decline at the end of December. This time caused by the combination of the approach back up to the long moving average and the congestion overhead between September to October last year. Yet the decline was not as far as in early December, and I suspect this was due to the newly drawn lower time, currently 661, of the July to December 2022 bullish shift pitchfork, which I've highlighted in bright green. You can see the recent indecision clearly, even this week, as yesterday reached a fourth countering daily action. And right now, today looks like a possible fifth. All this indecision has ultimately led to yet another pattern out there. A November 2022 to date, possible reverse head and shoulders pattern for slowly rising neckline, currently at 687. That was coincident last week with the slowly declining long moving average. So that is where we are after all that. In short, supported by the lower time in bright green and capped on top by this new neckline and I suppose the long moving average as well, closer in. Such a situation will not last for too long.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.